Alibaba, China's largest e-commerce platform with a global presence for retailing, cloud computing, and payments, has had its share price hammered into the ground in the past 12 months. Since its all-time high in October of 2020, the stock has fallen 54% and shows no signs of letting up. Investors have been left bewildered at the relentless downtrend the stock has been on, and looking in from the outside, you might think that the company's dying or laden with debt. But while the stock price has done this, revenues have done this. Fundamentally, Alibaba has never been stronger. Profits and free cash flow have soared, as have revenues, and the stock is now trading at prices seen as far back as 2017, getting to the point where it cannot be ignored by value investors. While it is the government regulation and initiative to achieve common prosperity that is weighing down on Chinese tech stocks, the fundamentals still matter and simply cannot be ignored. While it's not only Alibaba that has been exposed to heavy selling by both institutions and retail investors, a global survey of fund managers by Bank of America back in August also identified that shorting Chinese tech stocks has become the third most crowded trade in the industry. In this video, we are going to explore why Alibaba may be the growth stock that can provide the value opportunity of 2021. So without further ado, let's get into the video. Let's start off by looking at the financials for Alibaba. The company has consistently grown over the last 5 years, showing double-digit growth in the process. While profits may have been impacted by the rapid growth, only growing 4% in 2021, the company has demonstrated successful investment in its operations and expanding into other segments, such as cloud computing, where Alibaba is a dominant player in APAC and the Middle East. Net income growth is expected to grow at double digits once again, and the incredible free cash flow of $215.66 billion, a 42% increase from 2020, shows how robust Alibaba's financials really are. With no dividends to have to pay to investors, the company is well covered to repay its creditors many times over. You might ask, if the company does not pay a dividend, why should value investors be interested in the stock? Simply put, it is trading at a multiple usually seen by a company experiencing single-digit percentage growth. With a PE ratio of less than 18, the stock is far cheaper than its US counterparts such as Amazon and Etsy for e-commerce, and Alphabet for cloud computing. Many will argue that Alibaba should be discounted due to the higher risk premium of investing in Chinese companies, and that's a valid point. A like-for-like comparison between a company like Alibaba that is under regulatory pressure and others in the States operating in a free market environment should be taken with a pinch of salt. But the valuation disparity is extraordinary and could provide a great opportunity for investors looking to buy a great stock at a material discount. If you're new to Chinese stocks and want to know more about some of the potential risks associated with investing in them, make sure to watch my video on this topic so you have as much information as possible before planning on investing. I should caveat this by saying that this is not financial advice and simply my own thoughts on the topic. I'll leave a link to that in the description below or click on the banner in the top right hand corner to go there. To put the valuation into perspective, take a company like Barclays. As a UK bank seeing relatively steady revenues through 2020 and 2021, with a 0.54% dividend yield, the stock currently trades at a PE ratio of 21, a premium to Alibaba that witnessed over 43% revenue growth in 2021. Don't just take my word for it, let's have a look at the analyst price targets. Out of the 29 analysts that have provided coverage on Alibaba in the past 12 months, 25 were buys, 2 holds, and 2 sell ratings, giving Alibaba a consensus price target of $301.78 per share, implying a price target upside of 108% on the current share price. I would challenge anyone watching to find a stock trading at such a discount relative to analyst expectations with the financial strength and market presence of Alibaba. If you find one or have any suggestions, make sure to let me know what they are in the comments below, and perhaps we could discuss that in a future video. If you're based in the UK and might be interested in investing in US stocks, then today's sponsor Stake might be the best choice for you. Stake is a global, commission-free brokerage providing the widest, most sophisticated, direct access to the US market across both app and web interfaces. Currently serving over 350,000 customers worldwide, Stake does not charge any fees on trades, unlike Free Trade and Trading 212, who charge 0.45% and 0.15% respectively. The only cost incurred by users is a 0.5% FX fee on deposits and withdrawals. What I really like about Stake is their easy-to-use interface combined with great functionality ranging from straightforward financial data, analyst price targets from Benzinga, and the latest news on a stock so that you can stay up to date with industry insights and key information for investing. If you like the sound of Stake or want to try out a new platform, having sampled some others on the market, you're in luck as they're offering great rewards for new customers. For anyone who signs up and funds their account with £50 within 24 hours, they'll receive a free stock worth up to $150 in value. I think it's a great promo, so definitely check them out. I'll leave a link in the description below, and if you sign up through that link, you'll also help support the channel to allow me to continue to make these videos. So thank you for that. Anyway, let's continue with the video. With any stock analysis, we must assess both the upside ahead and any risks with our investment. To look at this stock from a balanced perspective, let's outline both the pros and cons of investing in Alibaba right now. Starting off with the pros. JP Morgan recently announced a partnership with Alipay to provide card payment services for Alibaba.com in the US. As JP Morgan Merchant Services is the #1 payment processing provider in the US, this opens up a huge market for Alibaba to expand its payment processing globally. Salesforce also recently announced the expansion of Salesforce Experience Cloud in mainland China alongside Alibaba Cloud, the leading cloud services provider in China. Notable value investors such as Manish Pabrai, Charlie Munger, and Al Gore have all made sizable investments in Alibaba, highlighting the value opportunity we discussed earlier. While some have sold due to the volatility in the markets, others have taken a contrarian approach and chosen to be greedy when others are fearful, heeding the advice from Mr. Buffett himself. One of the most overlooked factors of investing in Chinese equities is the interest rate environment. While most developed economies are at record low interest rates and even negative rates in places like Europe, China's benchmark interest rate for the corporate and household loan is 3.85%. In an environment where US and UK equities will see interest rate hikes in the medium term, hurting equity valuations, China still has the option of cutting interest rates, which it may need to do in the future to help the economy service higher levels of debt. As interest rates go down, valuations of stocks and other assets can rise, as their future cash flows are discounted at lower rates. On the 23rd of September, Alibaba Group CEO Daniel Zhang gave a speech at the World Internet Conference in support of China's Common Prosperity Initiative, stressing the importance of larger firms helping local talent in poorer regions. This rhetoric, along with the donation to the Common Prosperity Fund, shows that Alibaba is towing the line after Jack Ma, founder of the company, spoke out against the government. Working with the government appears to be much more constructive and may result in an eventual approval of the Ant Group IPO that was blocked last year. So those were some of the notable events that could prove to be catalysts for the stock in the near term. The earnings announcement on November the 4th is the clear indicator on the horizon to look out for and should reinforce the significant discount that the stock is trading at. But what about the risks? The key area of concern would be further regulatory intervention by the government. So much has happened already that has affected the price of Chinese tech stocks that it's hard to imagine further downside, but it cannot be ignored. Regulation affecting Alibaba directly relates to the breaking down of monopolistic moats and providing access to data and user bases across platforms. This, in theory, should break down barriers to entry for smaller companies looking to operate in the same industries, while also providing end users with more choice. The Chinese government also ordered the breakup of Alipay, Ant Group's payment processing platform, into several segments. This appears prudent on behalf of the government, as Alibaba was not taking any credit risk previously with their current business model, and their changes should not provide a material impact to its revenues. Another significant risk with Alibaba is the knock-on effect of the China Evergrande crisis. With the property developer on the brink of collapse, there is a high chance that its downfall could have an impact on growth in China. Indirectly employing over 4 million people, Evergrande could negatively affect consumer spending on Alibaba indirectly, leading to lower revenues. The government has been supportive of financial markets by injecting liquidity into the system, as well as asking state-backed companies to buy troubled Evergrande assets. The focus will be to quell any social unrest and support retail investors exposed to the property developer. Only time will tell the true extent of the fallout from Evergrande. The $15.5 billion donated to the Common Prosperity Fund by 2025 will impact earnings per share and needs to be factored into any valuation of the stock. However, many are mistaking it for a fine on behalf of the government, when in fact I think it is more deserving of a corporate social responsibility initiative. Large cap stocks that have thrived in their environment should always give back to their communities and support small enterprises, as they, after all, are the backbone of the economy. The bull and bear case for China has never been more divided. Some investors have deemed China uninvestable until the regulatory landscape becomes clearer. Famous investors such as George Soros have even gone as far to say that investing in China can be considered traitorous to the US. With rising tensions between the two world powers, that type of inflammatory rhetoric is certain to make the rounds and rile investors up one way or another. Some argue that the risk is priced into the current levels, with institutions such as BlackRock upgrading Chinese equities to modestly overweight and calling it the time to dip back into these stocks at such depressed levels. So, what's my verdict on Alibaba? The company is a cash flow machine and the leading e-commerce platform in the largest market of the world. An industry leader in cloud services and, unlike its US counterparts, the only end-to-end provider in the region. Regulatory risks do remain, and further volatility can be expected, but the stock is currently trading well below its fair value, at the same price it was 4 years ago. This makes Alibaba a highly attractive prospect to invest in, a high-growth technology stock at a heavily discounted price. For these reasons, I'm going to give Alibaba an 8 out of 10 and a buy rating. The stock is trading at an incredible discount, but remains highly subject to any further regulatory crackdown. Investors starting a position in Alibaba need to be willing to risk their capital for these reasons, but I think that a company like this, trading at such a low valuation in a world of overpriced equity markets, cannot be ignored. If you got value out of this video, make sure to give it a like down below and consider subscribing to Wise Wealth for more personal finance and investing content. Thanks for watching, and until next time, see ya.